D3. Thanks everyone for joining us today with this event. I'm very honored to have two of our original investors join us here, Patrick from Dispersion Capital and Alex from Reforge. If you guys wouldn't mind introducing yourselves, talking a little bit about the fund, and then we can kind of go through some questions that I have prepared around the state of early stage investing.
Sure. No, thank you, Michael. Yeah, super excited to be here. Happy to give a quick background on myself. My name is Patrick Chang, founder of Dispersion Capital. Dispersion, we're a pre-seed seed fund. We're exclusively focused on decentralized infrastructure. So everything that we work with all is kind of developer facing, but we kind of focus on what actually creates like mass world adoption through more like enterprise adoption. So one of, D3 obviously fit that thesis extremely well, and it's something that we've been super excited about. We were early investors in companies like Alchemy, Dapper, Blockstack, and many more. And yeah, we've been looking into, obviously with the Blockstack investment into name services for quite some time. So super excited to see what you guys are working on at D3 and DOMA.
Hey everyone, I'm Alex. Also, thank you for having me. I launched Reforge last year with a focus on pre-seed seed investing into what we believe is kind of the new age coordination infrastructure, addressing a lot of infrastructure markets such as labor markets, compute, data markets, capital markets, obviously. And really kind of focus on how do we improve the coordination efforts of incentives, of money, of people, so on and so forth. We invested and supported D3 at my last fund, and once again with Reforge, so obviously very passionate about what the team and the ecosystem is building towards.
Thanks, and you guys are at relatively new funds now, but you have been investing for many years. Can you walk us through what you saw in the prior peak cycle in 2020, 2021, and what the market looks like today in 2025? Maybe we could start with Patrick.
Sure. I mean, happy to talk about it. It's like I've been a venture investor for almost 20 years now, but for crypto, I guess the real cycles kind of really only happened around like 2012, 2014 timeframe. So there's been multiple cycles since then. So when we first invested in 2014, like pre-Ethereum, that was like true Wild West. That was like pre-token launches and all that kind of stuff. So fast forward to 2017, almost everything that you invested in essentially had that massive pop, because it was all novel. Every token launch had a lot of liquidity, not a lot of liquidity, but a little more demand for it. So and there weren't that many competition for token launches, and there also was not any locks schedules. So everything was big pump and dumps. All these big investors would just invest and just dump it all on retail. So it was, in hindsight, it looked like a pretty easy investment environment from an institutional standpoint. And I would say, kind of 2021, obviously we went through like multiple different kind of waves in terms of narratives. But it started getting a little more institutionalized. So we have these like greater lockups, these safe plus token warrants, more regulatory oversight. Back then, 2021 was also kind of where a lot of companies weren't starting to launch or form in the U.S. So almost took out a lot of like U.S. retail as well. But I would say now kind of looking into this current market. It's a lot more challenging in terms of trying to find these kind of exit pathways. But however, the flip side is it's a lot more accepted. It's a lot more interesting in terms of like people are now building for these real institutionalized products that actually have a true product market fit, rather than back then it was just like, hey, let's just like build something, let's launch a token, and then we'll see what happens or move on, that kind of stuff. So it's been super exciting kind of see the waves and the life cycle and the evolution and maturity of the market.
Yeah, I think for us, it really with any type of private markets investing, you really kind of treat the market as, hey, what is the window of arbitrage at this particular time? And so Patrick mentioned a few of those, and so even if we just go back to the last cycle, the last window was, hey, there's a bunch of interest building across every sector, whether it's NFTs, gaming, DeFi, infrastructure, but we have a safety net that is a token, and so even if we don't end up reaching product market fit, we can still make our investors money, we can still make retail money, we can still make money for ourselves. And so you can't ignore that window, meaning a bunch of early stage investors see that and say, okay, well, we're still gonna invest in these businesses that really have no long-term viability. And so we have kind of every chart going from left to right, down, right? And so I think we're all very aware of that behavior. And that's why there are so many generalized funds. It's like, okay, well, we kind of just want to put money into everything and see what sticks and take advantage of that window. In today's cycle, I guess 2025 vintages, there is a new window. And I think that purely focuses on fundamentals, which is yes, it's going to be much more difficult, but we really kind of are reverting back to, hey, you should invest in companies that solve user problems. Users want to pay to solve their problems, and then have also a high frequency of doing so. And so I think that we're essentially kind of seeing a closer collision between traditional tech and Web3. And honestly, I don't even like saying Web3 anymore because I just think that there's so much overlap that even the regular markets in traditional finance won't appreciate it enough. So this is all to say, when it comes to early stage investing, this new window is I'm spending a lot of time in traditional tech and talking to founders that really aren't necessarily thinking about a token, but understand that the cryptographic properties associated to this industry are very beneficial to their business, whether it's the actual token or the properties, meaning composability, being open source, having these unique incentives tied to the token. And I think that that's only going to scale further, right? Because you have SpaceX that's leveraging stablecoins. I mean, pretty much any business that leverages stablecoins understands this trend. And if you don't, for example, into the next few years, you're going to be dead. So I think that this collision is going to continue happening, but for us early stage investors, we just got to spend more time finding out what businesses actually have stickiness for the long term.
And you guys have done both of you have done a fair amount of infrastructure focused investing as well as some level of consumer investing. Are there differences in the approach when you evaluate some of these different projects, and does the time horizon change based on those? Walk us through your thought process when you evaluate investments between consumer and infrastructure.
I think the industry has done a disservice to the word. Over time, we always kind of have this dichotomy between application and infrastructure. Ultimately, my thesis is kind of cynical in the sense that I think infrastructure was an index to applications, and I think that this comes from kind of the fat protocol thesis that some of us were talking about back in 2017. Which is this idea of, hey, like there's going to be massive value accrual to the settlement and execution layer, further down the value chain of the blockchain stack. I think that still holds true, but why do you do that when you can essentially get closer to the end user that is actually making the purchase or making the sequence of purchases? And if you really think about it, infrastructure then becomes, hey, like, at least for the investor's viewpoint, an opportunity to capture a lot of the applications that are associated to that particular ecosystem. And so if I think specifically around L1s and L2s, like you do so because, okay, hey, if there is one massive application that draws a ton of users to come in, there's still going to be value accrual to the lower stack, part of the stack, which is the L1 itself. But that's not assured, right? The probability function of that happening is a lot lower, and so therefore you cast a wider net by investing in the infra. But then if you see examples like Hyperliquid, which starts off as who many consider an application, right? But then they built their underlying infrastructure stack. Chris Dixon has a word for this full stack company. This obviously exists in traditional tech. You essentially want to not have an identifier to say, hey, you are either infrastructure or application, because ultimately you should be both if you build it well enough. And I think that you guys are doing a great example, right? And so similarly, we say, hey, like you have a front end or an application that can drive distribution and usage which then translates to you requiring to build a more performant backend or infrastructure that then drives further growth and scalability on the front end. So it's a flywheel that I think really needs to exist, and you're seeing it happen with the most successful companies. So this is all to say, I find it really hard to now say, okay, like we are still just investing in infrastructure, because ultimately there's going to continue to be overlap that I think it's important for us to understand why that overlap exists in the first place.
Yeah, and I agree with everything Alex said, and I think for us we kind of see it from a long-term tech perspective. Like this is almost the same, history repeats itself. And if you look at how infrastructure was created, back in the 90s for early internet boom to 2000s, it all started, it always goes from infrastructure. So it's almost like a centralized, decentralized, centralized all over again. And it happened back then. So, we had to build the rails that all these future applications can run on. So back then, for internet, it was like all the old Akamai, Cisco's, and stuff like that. And we had these data, like old school data centers, not like today's data centers, that then eventually transformed into like personal computing, and that was more decentralized with like Microsoft and all these guys expanding. So this pendulum swing has happened throughout time and through every single technology shift as well. And so I think we're at that point in time right now with what we're are we still calling it Web3 or whatever it is, of time where we still have immature infrastructure. Even today, it's still like immature, but it's a lot more mature than 2021. It's more mature than 2017, stuff like that. But it's still immature. And I think now what we're seeing is there hasn't been that many users of Web3 yet. So that's why the application world hasn't really like taken off yet. And then the last wave, everyone was focused on application because we had, ton of gaming, ton of NFTs, but then that all dwindled. So then people kind of went back to the safety net of infrastructure, and which I think infrastructure gets confused because people say infrastructure, but they really just mean like token investments, essentially, not really fundamentally infrastructure. But I think today what we're seeing is a big maturity in the market, as we're saying, is like, people are beginning to realize that they need to build kind of full stack solutions, because you can build the best infrastructure, but if no one is using it, there's no point in this infrastructure. So a good analogy I tell people is, if you look at like Epic, with like Unreal Engine, they were an infrastructure company, but it was really hard to develop something on infrastructure. It's really hard to get people to understand what this infrastructure can enable. So you have to inspire the imagination on what this infrastructure can do. So you end up creating your own application at times. So you end up creating like a killer game, and you showcase like, hey, this is a reference design. And this kind of model happened all the way back in the chip days. So this ability to be able to create your own application, to really, you are the creator of the infrastructure, so you know exactly how to showcase how amazing this infrastructure is by creating this application. And then this enables other application builders to realize, hey, we can also build a better application on this infrastructure, and then that hopefully creates this like network effect. So that's the kind of we see like the application and infrastructure trends happening.
Makes sense. And I guess with the proliferation of all the tools available now today, and especially with AI, what are some of the signals you look for in early stage projects among these founders? Maybe Patrick, you can start.
Yeah, I think like the most important thing, because we're just talking about like infrastructure, not, when people are building back in the day, it was just like, hey, we'll build it and they'll come. So there was no like true real pull. And now what we're really looking at from a early stage point is like, what's that pull and what's that real world like problem that they're solving that can enable say an enterprise to adopt it, say somebody to actually use it, versus hey, we're going to create this super cool new widget or really cool infrastructure that's reinventing the wheel. If you don't actually have a true fundamental need for it, if there's no problem set that actually has some sort of pull on it, there are no developers integrating with it, no ecosystem around it, it's like really hard for us to get super excited about it these days. Because everything for us is like we have to kind of see, what is that real world product market fit. I mean, we're pre-seed investors, so there won't be actual data, but there'll be signals that could point towards true traction.
Yeah, I think it's very difficult to I guess provide tangible examples of what it is. I think it's all on a case by case basis. But I would just reiterate the problems. People joke the industry has always been an industry that loves to create solutions for nothing. Because at the end of the day, like, I don't think the question, does this need to be decentralized or does this even need to exist on chain, is asked enough. Because if you ask that and then you go out and say, hey, these prospective customers or users that existed in this company's pitch deck, they don't actually give a fuck about this that you're building, and you actually talk to them, you realize, okay, like this was all, a narrative, right? Like that's what a narrative is trying to push down this idea or to spread this idea that may or may not actually persist. And so I think that like validating that and just doing, the basic homework of, hey, like, instead of taking it at face value, just validating, speaking to prospective customers, users, is something that we do. There is no data, right? So our sweet spot is coming in either right after the angel round or the first institutional check, and so it's very much a founder bet. And so I would say a lot of the more tangible stuff is around how the founder perceives the market that they're trying to address, and I think it's incredibly important that they have kind of the non-obvious insight to a very large market. And I just think that in many cases that large market is fake in crypto because because there's unlimited total addressable market when my grandmother is open to buying a token, right? And speculation is an unlimited addressable market, and that has been the product for the industry for so many years. And so I think that just breaking that wall is really all it takes for a lot of these investments.
Got it. In 2024, we came off a pretty hot market, right? Over $5 billion in capital deployed in Web3 startups, potentially probably even more. And the beginning of this year, we had the new president, right? We had a lot of geopolitical factors, a lot of volatility in the market. What does the funding environment look like right now as it stands with regards to seed and pre-seed deals?
Yeah, sure. The environment is I mean, from my vantage, tough. I think a lot of it is still forced, right? I think I'm spending more time in traditional tech. Hey, this founder has identified a really big problem with a very unique solution, and the conversation is like much longer than, hey, I'm diligencing you to see if I want to invest in you. It's how does this become enhanced if I introduce crypto? And many times the answer is it doesn't, right? And so then I start over. I go out and I continue looking for the right opportunities. Because frankly, there's we're seeing a huge discrepancy with talent as well. So even if we disregard the capital, because capital is very abundant, they always say the best teams pick their investors. The discrepancy is talent is still flowing out of this industry, right? Like the best talent is still going to much more attractive sectors, and I think that the only way to kind of draw them back in is saying, hey, like instead of you building a crypto company, you guys are building a regular company that is solving a problem, and you have features that involve being on chain, or you have features that involve having a crypto component. And I think that expands the opportunity massively, and that's why I'm never talking about Web3 or Web2 or I'm a crypto fund, because we're just a tech fund at the end of the day, and crypto is a great technology that just honestly needs to be utilized in the right way. So I think that the environment specifically within crypto I think is tough. People really only give a shit about gambling, like the casino. and then you obviously have like unique use cases that makes up maybe 10% of interest, because who's the marginal buyer? All the marginal buyers are holding blue chips. Everyone jokes that alt season is Coinbase or Robinhood, right? Like nothing on chain is actually worth buying. And so like if you think about it, then it's like the funding's not going to be there either for private markets. So this is something we have to go out and then introduce. I'm happy to talk about those ideas, but I think it's not pretty specifically in crypto, but obviously a massive opportunity outside.
No, yeah, and I would say like if I kind of flip it from where we kind of sit as investors, obviously, you know, as Alex was saying, a lot of the talent also kind of left Web3 for AI because, you know, that's a more attractive area. That's where people are getting a ton of funding. But also in 2024, like as Michael was saying, is like there was a lot more funding because, you know, the market's maturing itself. There's a lot of you know, new companies being built, a lot in AI crypto as well. But there's an interesting dichotomy that's also happening is, as Alex was alluding to it earlier, is a lot of these token launches, a lot of the, you know, alt market has not been performing that phenomenally well. Obviously, you know, new token launches are not you know, popping or sustaining their launch prices either. I would say with the whole like wave of meme coins that also just ended up creating a ton of I don't want to say like distraction, but just more variables in terms of like how many different tokens there are out there. So, you know, retail, institutional, they're all spread incredibly thin, even though the market is actually growing as a whole, but there's just too many tokens out there for people to actually focus on or concentrate on. So what also ends up happening on this dichotomy I'm mentioning is from a seed stage or pre-seed investment, a lot of times when you invest early on, you know, you have this, you know, safe with a token warrant that has a different cap on it. And in the previous wave, a lot of us as investors were okay with, say, you know, this different ratio of 1 to 1, 1 to 2, something that was higher because, you know, the outcomes were also higher. You know, we saw that path to liquidity. We saw an exit that had a very high FTV. And we could justify these higher valuations. But today, it's really, really, really difficult for any investor to justify these valuations because, you know, the exit path is no longer there. And so we're almost seeing a lot of these investors only being able to get, you know, 1x, 2x on token launches, maybe 5x max. But, you know, if you're like a pre-seed seed investor, but, you know, the returns just aren't there anymore. So it's very difficult for a venture investor to underwrite these opportunities. And then the flip side is founders don't want to lower that either because there are, you know, ownership percentages. You have that, you know, pie of like you have to only give X% to investors and beyond. And it's super difficult to make that math work if you give up the valuation cap at too low a valuation. So, you know, we're kind of in this like, you know, no man's land at the moment. So it's pretty difficult for funding on both sides.
I had a question.
There you go.
I had a question for Alex on the marginal buyer. This year we saw the rise of iOS apps like Moonshot, Vector come to market, and more recently Coinbase announced the integration of the DEX, DEX platforms being supported by the Coinbase core product suite. Is that enough to trigger what you consider, more retail adoption, creating more marginal buyers, or is there another catalyst that you are waiting to see that really unlocks the kind of next wave of adoption and like true, actual, unique user growth
Yeah, I think there's just going to be a never-ending demand for financial products. I think that's why crypto is what it is with respect to DeFi, and I think there's very few use cases outside of finance. And so yeah, I mean, if you just compare crypto markets to traditional financial markets, we're still less than 5%. We account for less than 5% of flows. And so until that becomes 10%, 20%, yeah, massive opportunity. But that's why everyone's just creating DEXs. That's why everyone's creating these opportunities to trade shit. Like that's really what it is. Because capital markets offers, at least for the retail, the marginal buyer, frequency and necessity, right? And frequency meaning, hey, I'm going to continue striving for, retiring my bloodline and saying, hey, like, I'm going to make it big because I invest in this meme coin, because I'm trading, or I'm trading on leverage. That is part of the 7 deadly sins, right? Greed. And I think Hoffman says it best. You should always invest in companies that revolve around the 7 deadly sins. And so greed is a core driver. That's why, every example you mentioned has something to do with trading, right? It has something to do with, hey, how do I get exposure to this asset? How do I get exposure to leverage? Or how do I get exposure to upside? And then, and the other side of it is doing it at a really high clip, right? Hey, like, okay, I didn't make a good trade here. I'm going to continue doing it, and then you start making fees off of that, and that's why the most profitable companies outside of AI are these trading platforms. So to answer your question, like, yes, there's still like significant growth to be had. And then you kind of create all the tertiary stuff around it, like cross-border payments and stable coins, and you leverage all of that stuff, which is great. I think that's very foundational to improving general financial markets in general. But then, like, if we look beyond that, I think it requires teams like you guys, and then just very like unique. Hey, there's ownership to be had in the digital world, and doing it that it makes it easy for the end user, or it makes it easier for the end enterprise. To say, hey, like, we're abstracting away a lot of the crypto bullshit, but this is particularly valuable because no one, people didn't realize they wanted a car; they just wanted a faster horse, right? So you're introducing something novel, which I think just needs to continue being iterated upon. But I would say like 90% of everything that's happening is still financially driven. So that's for the marginal buyer. That's what they care about.
Yeah. Frankly. Does that make you a fan of the app chain thesis, or is that?
I think that's all like conversation around your form factor, right? Like, I honestly don't think it matters. If you can deliver your product in the highest efficacy possible for both you, your team, and the end user, like, do whatever it takes. Like, monolithic chain, app chain, roll up. I mean, I literally don't care, right? So it's just a means to an end. In my book.
On the point of supporting maybe your portfolio, what do you think is the best way that entrepreneurs can work with their investors to kind of extract or create the most value from the perspective of like a seed stage or a pre-seed fund?
I mean, in my opinion, I really think making your investors work for you. They've seen a lot of different companies. They've seen a lot of companies. What's worked, what hasn't worked. What we do a lot with our portfolio companies, like, try to see how they can get that real world enterprise adoption. So it's almost a rinse and repeat method. We have the playbook in terms of, we've seen how companies from a BD perspective or partnership perspective, how they integrate with enterprises. So a lot of times these founders are technical founders. They don't have the sales acumen or understanding on how large companies kind of work. And if we're talking about trying to get that mass, like, real world adoption to happen, especially on the enterprise side, it's like, these big companies go through certain processes that, there's tons of hierarchy. So we try to cut through a lot of that hierarchy, but we also have to have try to help the portfolio companies who are usually younger, smaller companies to understand and how to play that process. So we kind of give them the best chance of success to, enable them to kind of win these deals. So that's kind of what we kind of advise a lot of portfolio companies to do in this current environment.
Yeah, I mean, I treat it like a founder-customer relationship, right? People say venture is a two-sided business where we have customers on our LP side, and then we have customers on our founder side. So founders are our customers, and so what can we do to make their lives easier? It's a case-by-case basis. We're investing in college dropouts to very successful former operators, and so there's a huge spectrum of what we can do and what we also can't do, right? I'm not going to be like, oh, I know more about this than the founders, or honestly, I shouldn't be backing them. And so that's quite the yellow or red flag. So yeah, I think for us, it ranges from, hey, like, we are just fully aligned with what you're working towards, and we will continue being an ambassador and a cheerleader, and we will pick up the 3 a.m. call when you need it, to, hey, like, your data room's a mess, like this is what we believe you need to do to clean it up so that you can raise from the Sequoias of the world. So it really is different. Specifically for us, like we do have a particular expertise in being more technical. My partner and I were former engineers. We were also former founders, and so we were in the seat that our founders are in now. And so we just kind of have that rapport that we understand what they need at certain times, and so we just want to be there for them, right? Whether it's answering the call or getting into a whiteboarding session for a few hours. So I think that I think moves the needle, because look, I'm an early stage fund, and so I can't really compete with the Andreessens of the world with a marketing team, a platform team, an engineering team.
I have one more question, and then we have a few minutes to open up to the community. Moving into 2026, given Circle IPO and kind of the appetite in that market, how do you think that will impact the market, startups in terms of how they think about building a successful startup, and now IPOs opening a broader pathway to more stakeholders? Does that change the tokenomics and the model and the go-to-market for a lot of these projects, or do you view that not much will change?
I think the biggest change is more kind of the bridge acquisition as well. I think that opened the door for a lot of traditional business models. In the past, it was super hard for traditional, equity-based only startups in the crypto Web3 world to get funding. Everyone wanted a token. Every investor was pushing portfolio companies or startups that they should launch a token because they wanted that path to liquidity. But now the irony is, it's an outlier as well. But Bridge was a quote unquote big acquisition that actually had an exit. And now investors are more open to these equity only type of rounds. Circle as well. Once that went IPO, they saw this path to traditional markets too. So we're seeing a slew of stablecoin equity only type of businesses and other type of traditional institutional businesses getting funding. And now people are not pushing so hard for only equity type investments. So I think that's kind of been the biggest shift in this cycle.
I think this all just goes back to regulation. I think people are always thinking about, how does the industry align with the SEC, or how can we get the SEC to buy in? I fundamentally believe that it's going to be neither of those things. There's just going to be a fundamental eradication of securities law. Securities law just cannot keep up with everything that's happening in the world with respect to asset management. So I think that I don't know what will catalyze that, but I truly believe that securities law needs to change. Fundamentally for any of this to actually kind of go beyond what we see today, because the SEC has all the incentive to continue operating in a gray zone, right? There's no reason for them to be we will take one side or the other. So I think it's a structural flaw, and that needs to be addressed. Second is, for that reason, I don't actually think there's going to necessarily be a lot of IPOs. Because that gray zone continues to exist. And alternatively, I would suggest founders to say, fuck the regulation in the US particularly, because you have a very, very profitable business that is generating more revenue than most businesses in the US or globally for that matter. And they're doing buybacks, and it's passing the Howey test, right? So there is a fine line that you have to see, and the more examples of that happening will then drive the change in securities law. So that's my, I guess, hot take, frankly. But I just think that it's a very simple model of, hey, generate revenue, buy back your token, don't IPO, have your token, a token exists so that you can address or be a part of open financial markets, right, on chain. which opens up a whole opportunity of individual sovereignty, et cetera, et cetera. But I think that that's the direction most businesses should go, versus, hey, like, we should go the IPO route. Oh, like IPOs are now coming back, because I think Bridge, I think Circle, with very institutional use cases, have a very linear path towards that, but that's not for everyone. And I would say that's actually part of the minority.
Got it. Also, shout out to our friends at Privy, who also got acquired.
Yes.
We have time for maybe one or two questions. Does anyone in the audience want to ask a question for Alex or Patrick?
Hey, what's up? Thanks for coming, guys. Have you guys seen a lot of utility-based coins with different companies with direct licensing and like direct protocol when somebody purchases the token?
Can you explain that a little more?
So I did a deal with Hard Rock for F1, and we did the tokens for like a utility that unlocks all of the, I guess, entertainment that's provided by F1 and Hard Rock. So, you know, me and my friends were talking about this for years until recently, because I know you guys seen it kind of open up with time. So I was just asking you guys, since you guys are, you know, really in the game right now, have you seen other companies do tokens that give the buyer or whoever is investing in it access to the company's, you know, utility-based, like, you know, hotels, flights, you know, entertainment, anything combined with mostly entertainment?
Yeah, I mean, I could, you know, I haven't seen it from a token side where if you buy the underlying token to unlock utility, but I've seen a plethora of NFT type of based projects. So like any ticketing based project, NFT per se, like if you buy their NFT that unlocks, you know, all these different benefits, that's been very common. There's a slew of them. I mean, even, you know, last wave, or was it 2 waves ago? I don't even know anymore. Like, you know, Bored Ape Yacht Club, that was all around their premise of their community, and many more have done something similar as well. But I don't know, from a token perspective, I haven't seen any.
I mean, it's actually counterintuitive, right? So, hey, I want to use this token to create utility by unlocking X, whether it's a membership, whether it's access to something. But then it's the token that you want to accrue value. So it's like, why will users want to pay an increased premium price of a token to unlock something? And sure, it can have a deflationary effect where it's like it continues to get smaller and smaller if the price goes up. But like, no one wants to deal with that. What you describe is really just a subscription model, and you can easily use stablecoins and then an NFT, you know, a different token standard to unlocking the same effect. Because if it's the utility of the token itself, in which the founders, the investors, everyone, even the buyers, want the price to go up, no one cares about the utility, because you could just use so many other alternatives for it. So if I see it happen, I actually think it's counterintuitive. I think there are better ways to do it. And so just having to really think through, okay, like, is this necessary? And 9 times out of 10, it's not. I just haven't experienced the 1, out of 10, or the, I guess, minority use cases in which it does work. But like Chainlink hires an entire 50-person team to ensure that what you just described, like, hey, use the Link token to access our oracles, right? But at the same time, we want Link to go up. Like, that's a 50-person PhD level economics problem that they're paying, annually for, and it's sitting at what, $13, $12? Like, I think it's just a very counterintuitive economic thing to say, hey, this will be very utility driven while also accruing value.
Well, I mean, deep-in projects kind of do this, where they have the utility token, but then they realize they can't use a single token model. So a lot of times they end up breaking it apart and having 2 token models, which is actually sometimes even worse. So that
Right.
one, the main token appreciates or doesn't appreciate for no reason, but then they have a stable coin type of token that's purely used for utility for the deep-in ecosystem. So yeah, you have too many competing forces around there.
Yeah, it's tough.
Thank you, Alex and Pat, for coming out here. and sharing your thoughts with us. One of the comments that one of you made earlier was that there is a brain drain in Web3, if you want to call it that, to enterprise AI. I wonder if you, Pat, in your own deal flow that you've seen recently, or Alex and competitors that you are seeing in the landscape, that there is possibly some convergence in the enterprise AI and tokenization space, and what that looks like, or maybe some foresight into what that possibly could look like.
I personally am all game for what you said. So I think there's going to be a lot of enterprise AI that just fundamentally enterprise AI. There's not going to be any uses for any crypto elements. Especially foundational models. They're all extremely single siloed. They have their ecosystem. Everyone builds on that foundational model. There's no need for crypto elements to it. But I think the biggest wave that's kind of happening is around these like autonomous agent, this agentic internet, all of this new world of agents. This is really where the true convergence is going to happen, and this is where I believe where crypto actually plays a needed form. Like it's you just can't do it without it. Is around these autonomous agents that are going to end up having to do microtransactions, regular transactions, paying, but all in a compliant way as well. So you can't be truly anonymous. You can't do any of these. It all has to fit regulatory frameworks, and has to fit like KYC, KYB, or KYA. Know your agents or anything like that. So that's where I see true convergence happening, especially in the short term. Long term could be all kinds of other stuff, but I definitely see that.
Yeah, on one end of the spectrum, you are an enterprise business. You are absolutely crushing it. You launch a token and you do buybacks. Literally, you just IPO'd into an open financial market. The other end of the spectrum is what Patrick is saying. Definitely believe there is a convergence, more so on the product side and infrastructure side. But I think it goes back to, is it truly necessary? Like, who is your buyer? There's an incentive for larger corporations to not adopt that model, right? They want to stay with the walled gardens. I guess the one kind of potential light at the end of the tunnel is you have all these open source projects that have done really well. So, your MongoDBs of the world, you talk to them and they have struggled for years to truly monetize open source. I think that that's still a big problem. And I think tokenization is a solution for that. But how that actually looks at scale when it comes to true enterprise adoption, and then saying, hey, like you have to have a token involved in the whole either financial or the utility side is a complete toss-up, frankly.
We have a hard stop for the next session, but for those that have attended the panel, what's the best way they can get in contact with you guys?
Zoom link for Alex.
Yeah, no, my Telegram got hacked, so don't hit me up on Telegram. But I do have a new one. But I actually just hate that platform. So Linfluence on Twitter, it's just influence with an L. My last name is Lin, I'm not that much of a...
Patrick?
Yeah, I still use Telegram, LinkedIn, old school, anything, also Twitter, so you can reach me everywhere. It all goes to my phone.
All right, let's give a round of applause. Thank you so much.
Thanks, everyone.
Thank you.